People really don't know what their expenses will be because they don't know how long that they're going to live.
Americans are worried they won't have enough saved for retirement now more than ever.
Retirement is going to cost, for many folks, over $1 million.
Is no sure thing in investing, but a lot of people think that annuities may come close to that.
It's going to more safe things that they know. If they know they're going to need that money to supplement their retirement, well, then you can't play that risk.
This is the Safe Money and Retirement Show with Jon Heischman Sr., founder and partner of Heischman Financial Services, serving the Columbus and surrounding areas. Jon specializes in educating pre-retirees and retirees about safe money strategies and ideas. Now, it's the Safe Money and Retirement Show. Here's Jon Heischman Sr.
Welcome to Safe Money and Retirement. I'm glad you tuned in. This is Jon Heischman, your host. I want to talk about sequence risk. Very important for those that have just retired or in retirement that you need to be aware of in income planning. What is sequence of risk? You know, it's also called sequence of returns risk. It becomes a danger as a retiree takes withdrawal from funds or fund underlying investment. The order of the sequence of annual investment returns is a primary concern for retirees who are living off the income and capital of their investment accounts. Now, here's the danger. An investor receives lower or negative returns due to withdrawals made from their investment. Long-term average returns and the timing of taking those returns could impact financial wealth. Financial outcomes can be dramatically different depending on when and how a retiree begins their retirement income. Issues like state of the market and if it's a bull market or a bear market are not under the control of the retiree. However, investors do have some opportunities to limit their downside risk. When protecting against sequence risk, retirees have a range of options for protecting retirement assets against sequence of risk, including working longer, putting off retirement, and planning with a worst-case scenario regarding rates of return, continuing to make contributions to the retirement fund could help offset losses during market downturns and provide capital for continuing growth. Investors, they may diversify their portfolio away from higher risk stocks, which can see considerable fluctuation in value based on the state of the market. Or probably the most important way to offset sequence risk is to make sure the majority of your income comes from guaranteed sources of income. For example, Social Security, a pension, or structuring part of your retirement savings into guaranteed sources of income. A private pension that provides that income regardless for the rest of your life. And it's even more important if you're not fortunate enough to have a pension plan that pays that income. If you haven't looked into guaranteed sources of income that can be generated from a portion of your retirement savings, please give me a call and I will explain how that works and see if it's in your best interest. 614-861-7055. Again, that number is 614-861-7055, and ask for me, Jon Heischman, Sr. Now, I say senior because my son is in practice with me, and his name is also John, and he goes by Junior. Okay, why does sequence risk matter? The sequence of returns risk may significantly impact the income available during retirement. Let's take two retirees with identical wealth. They can have entirely different financial outcomes depending on the state of the economy when they start their retirement income, even if the long-term market averages the same. Example, a person entering retirement at the bottom of a bear market will see the prices of the holdings in their portfolio rise when the market recovers. More crucially, the retiree will also see a reduction in the overall return that portfolio because of how much had to be withdrawn in early retirement when prices were down. Plus, this retiree is essentially withdrawing funds at his or her portfolio losses value. Consequently, the retiree would have less shares of equities which can benefit from positive returns down the road. Now, by contrast, someone who retires when stock prices are high, letting him or her take early withdrawals of fewer equities because they are worth more, will likely have a higher overall portfolio return than the bear market earns. This is because the bull market retiree has more equities left in that portfolio, which can allow this retiree to continue earning returns later in retirement, particularly during a period of strong market returns. So you can see how the market can affect a retiree's portfolio, especially in early retirement. Now, we can hope that the portfolio comes back, but the amount it has to come back to make up for losses is more. And when a retiree is depending on that investment portfolio for income for 20, 25, 30 years, there could be a big problem. We want to prevent this problem, which I have done for my clients over the many years I've been in practice. In retirement planning, it is so important to establish that guaranteed income source that's going to be there, guaranteed, for the rest of your life. I establish an income needed, adjust for future inflation. Then we generate that guaranteed income. And I always try to make sure there's some left to go into a stock bond portfolio for my son to manage. If the market takes a downturn and possibly gets exposed to sequence of returns risk, future income is not jeopardized because, remember, we've already established your guaranteed lifetime income. Those of you listening to me and my message, probably the majority of you, have not heard of sequence risk. I don't want it to be a surprise in your retirement because you've never heard of it and all of a sudden you get exposed to it. Give me a call. Let's talk about how much you have at risk in those accounts that are going to generate retirement income for you. 614-861-7055. 614-861-7055. Thanks for listening today, and be sure to go to our website for more shows that I have done in the past by going to HeischmanFS.com. HeischmanFS.com. This is your host, Jon Heischman Sr. Thanks for listening.
The Safe Money and Retirement Show with Jon Heischman Sr. To get in touch with Jon, call 1-888-426-0177. That's 1-888-426-0177. For more information about Heischman Financial Services, visit their website, HeischmanFS.com. That's HeischmanFS.com. Join us again next time for the Safe Money and Retirement Show with Jon Heischman Sr.